So let's take everything that we've been discussing, put it into the porridge, and figure out how does that translate into what you do with your portfolio. What do you do with your books? Joining us now is Alex Gunz. He's a fund manager at Heptagon Capital. Alex, welcome to the program.
Hi.
The downgrade of the U.S. Of the United States' credit rating, does that make a difference to your portfolio structure?
I think we've generally been quite cautious on equities for some time, and that's been reflected in our relatively low net equity exposure. And I guess in terms of how we're positioning ourselves in our portfolio, it's generally towards more defensive names. And I think really our decision making is trying to look around and identify the least bad options available at the moment. Relatively speaking, I still think the US is a better place to invest than many other regions.
US over Europe, US over Asia?
US over Europe and US over Asia, yes, that's right.
How overvalued is the stock market right now then?
I think that there's certainly a case to be made for saying that the market's overvalued.
Why?
Just because my sense is that earnings momentum is close to peaking at the moment. Consensus estimates have perhaps got a little bit ahead of themselves, and again, that's why in general terms we're either looking for more defensive names, in particular say within the telecom space, or companies with a lot of pricing power in their end markets, or we're looking for sort of single stocks that we continue to believe are actually undervalued.
And what do you make of the increases coming through in commodity prices and oil price in particular? Is this something which is a possible major threat to the equity market for this year, or can it just easily shrug these kinds of things off?
I mean, I think in general terms we've been quite surprised by the sort of number of exogenous events that have actually happened for equities over the course of this year. I think as the oil price moves higher, that clearly does represent some sort of concern. Likewise, the move in commodity prices as well. And in general terms, those are sectors where we're trying to sort of stay out of and not actually gain any direct equity exposure to at the moment, simply given the sort of oscillations, the volatility. And from my point of view, I feel much happier, we feel much happier at Heptagon trying to sort of pick stocks, understand sectors where there's much greater visibility and near-term clarity.
How do you explain the fact that you've got gold prices rising very, very rapidly over the last few months alongside these relatively buoyant equity markets? I mean, normally the rising gold price indicates lots of risk and lots of concern, and everyone's very fearful about the future, yet at the same time equities are quite elevated.
I mean, I think that gold remains a very sort of sensible default option, and given the sort of well-documented concerns that there have been about inflation and the fact that we're getting inflation data points from across the world from many different sort of sources, that I think to an extent plays into the argument for owning gold at the moment. So I can sort of understand why the gold price has been going up, and similarly the factors driving other commodities, they seem to be related to sort of macro dynamics, food shortages, and so on.
Alex, you've got a couple of stock picks.
Sure.
Let's just run through them just briefly, just to give viewers something to do a bit more research on. Smith's Group, Aggreko, and Tele2. Why?
Absolutely. Smith's Group we like because we think there is a very strong management team there. We see very good scope for the business to realise or unlock value within the assets. It's got three very distinct businesses. We think that in particular the security detection asset is very attractive. Management's doing a very good job in terms of improving returns, and we think over the medium term there's a very good and likely case that the assets will end up, or the group will end up being split up.
Okay. Aggreko?
Aggreko we like because this is a sort of classic business where there's a supply-demand imbalance. The demand for energy is growing, as we've talked about.
Temporary power company.
Exactly,
Yeah.
It's a temporary power solutions company. The opportunity cost of not having energy is massive, and Aggreko, to our mind, has got dominance in that field, and as a result they're continuing to grow very successfully.
Big contracts being signed in Japan, I understand, at the moment.
That's right, yeah. They were clearly the sort of tragic events that happened with the Japanese earthquake and the nuclear events there. And I guess one of the points about the Aggreko story is that there's clearly a secular element to it, in other words, where countries which don't and can't afford to invest in electricity infrastructure will actually use Aggreko's services. And then clearly they're also the leader in temporary power solutions, whether it's for events that happened in Japan or something like the Olympic Games.
And briefly, Tele2 out with results tomorrow.
Yes. Yeah, we like Tele too because it's worth highlighting telecoms have been the second best performing sector in Europe year to date. We like the cash return story. They announced a special dividend earlier on in the year. Shareholders can still continue to benefit from that. The balance sheet is very markedly undergeared, only 0.2 times net debt to EBITDA. They can take that up to 1.5 times, so we think further cash returns are very likely.
Interesting. Alex, thank you very much. Thanks for coming in. So again, that was Smiths Group, Aggreko, and Tele2, if you want to do a bit more research on it at home. Alex Gunz, the fund manager from Heptagon Capital.